These are Nebraska corn farmers. They work in acres, not hours, harvesting the energy and climate solutions the world needs. We are proud to stand with you.
The success of tomorrow's soy industry depends on the actions we take today. The future is here, and the time to move is now.
Market Journal Television for Agricultural Business Decisions is a presentation of the University of Nebraska-Lincoln's Institute of Agriculture and Natural Resources in partnership with the Nebraska Rural Radio Association. Promotional support provided by the Nebraska Farmer Magazine and partial funding provided by the Nebraska Soybean Board and the Nebraska Corn Board.
Well, hi everyone, I'm Bryce Duskett, and thanks for joining us today here on another special edition of Market Journal. Where are the grain and livestock markets going in 2026? If only we had an easy answer to that question, perhaps a crystal ball. Well, I've got the next best thing for you. It's my colleague Chad Moyer. He had a special recording session during the Nebraska Ag Expo. Two experts to break down that topic exactly. And on this week's show, we'll get into that conversation. So without further ado, here's Chad Moyer.
We are here at the Expo EDU stage at the Nebraska Ag Expo in Lincoln, and we're going to talk grains and we're going to talk livestock today. We have two panelists with us here today. First of all, Ross Baldwin. He is with agmarket.net, does corn, soybeans, does the grains, but also focuses a lot on livestock. And Matt Wigand is with Futures One, based here in Lincoln, and he's going to focus a lot on crops here today. First of all, let's get to know our panel. First of all, Ross, if you would, a little bit of background about you and agmarket.net. Go ahead.
Thanks for having me, Chad. As Chad said, my name is Ross Baldwin. I'm from Anthony, Iowa. It's about 35 minutes southeast of Sioux City, so I'm on the western side of the state. Grew up on a cattle feedlot. My family still runs the feedlot today, but my passion's always been livestock. And so in 2020, me and two partners that are in my office, we joined agmarket.net, which is the farm division of a commercial company called John Stewart and Associates. So we focus on, risk management, working with grain farmers, livestock producers, and commercials.
All right, Matt, tell us a little bit about you and about Futures One.
My name is Matt Wigand. I'm originally from Harbine, Nebraska, between Fairbury and Beatrice. Been with Futures One. You just finished 17th year there, or started 17th year there in November. So I worked with grain and livestock producers, from northwest Kansas up to Minnesota, covering a variety of crops and livestock approaches, cow-calf, backgrounding, feedlots as well. Futures One, we're celebrating our 25th year this year. We're based here in Lincoln, but we have offices in Ogallala, Kearney, Nelson, as well as Ames, Iowa now.
All right, very good. Well, thanks again for being here. Since this is kind of a big, and we'll start big and broad and kind of drill down into some things that are going on in the markets right now. But since this is kind of designed to be an institutional knowledge podcast, we'll start with you, Matt. What are the essentials when it comes to marketing any agriculture commodity, whether it's grains or livestock, but specifically on grains, putting together a risk management plan? What are the essentials in your mind?
I think, a lot of the essentials to me comes from knowing your cost structure going in, what it's going to cost you to grow each crop, kind of where the potential is and where the risks are, whether you're dry land or irrigated, to plan forward, kind of where your insurance coverage is. There's been a lot of new insurance products added the last few years where you can cover some different margins, things that sometimes provides a little bit better coverage than using traditional options or things of that nature. Also just trying to see what your plan is, where your cash flow needs are going to be, at harvest and into the new year, whether you have the opportunity, if you have a lot of on-farm storage, there's a lot of years there's going to be carry opportunities. I think we're certainly coming into a year where we have that, at least into the first part of the year. Also just trying to, seeing, I guess with the break evens and and moving that forward, I think is knowing where you're at on that front is going to be key into the next couple of years until we see how the market develops as far as where trade's going to go coming forward, and as well as the increased domestic consumption with the new soybean crush plants and things of that nature. It's just going to take a little bit to get going, and that's where knowing where your break-evens are, where your cash flow needs are, coming into harvest and post-harvest are going to be key because in a weather situation, there could be a lot of opportunities there, but it's also with where production's been the last few years, they can go away in a hurry. We saw that this summer where we really had friendly grain reports. Markets did nothing with it because it felt good about a big crop coming, and that kind of took away some of your late opportunities that you don't get some years, whether it's you get a weather scare in July, it can really take off, or you get an acre move in the spring and it can really take off, and we just never really got that this past year with where even with good demand, the weather kind of overcame everything and kept the pressure on the market, and that's where there's a spot to gamble and opportunities a lot of years there with bushels, but it's also staying ahead of that and you're not being in the position where you need the weather rally is always kind of the goal, and making sure some of your bases are covered otherwise there.
Yep. Matt, what are your thoughts in putting together a risk management plan for livestock? Are some of the concepts the same, or what are the must-haves for livestock?
I think a lot of the concepts, knowing what it costs you to gain is whether it's hogs, chickens, turkeys, beef, whatever it may be, knowing kind of where your cost of gain is and what your incoming price is going to make a lot of the difference, as well as as we've seen with the Tyson deal, knowing where your animal is going to go to at the end of the day, whether it's local sale barn as a feeder, or to a packing plant as a live animal at the end. I think you kind of having that structured and knowing where your risk is there, and in this, especially in this environment, cattle wise, when you have a limit move up or down once or twice a week, it makes it a lot harder to use options, makes it hard to use futures, but you also have the opportunity to be if you can stomach it, there's been some great opportunities to lock in prices that way, and we'll probably be coming forward, and if the market continues to calm down, some of the option opportunities will look better there, as well as managing some of the LRP strategies that are available to producers too, that you can make sense in some situations.
Ross, what are your thoughts in what are the must-haves of a marketing plan, grains or livestock?
The first must-have, it's very similar to what Matt said, is knowing your break-even. Whether it's corn, beans, wheat, cattle, whatever the commodity is that you're working with, the first thing is know your cost structure and where your break-even is, and then build a marketing plan around that. And essentially try to take the emotion out of it. And I'm just as guilty as anyone. I'm a producer myself, and it's extremely difficult. In the cattle markets, what we've seen over the last 2 years, especially the last year, is it's been as volatile as we've ever seen. And every day that you wake up, you're more than likely long cattle, and if you're a grain producer, you're more than likely long corn or beans. Anyone that I've worked with, I've never really seen anyone that's been completely hedged, 100% sold on corn, beans, or cattle. And finding a place to where you get that risk managed in a comfortable spot and something that you can live with, and just try to take the emotion out of it. And it's difficult. It's easier said than done a lot of times.
Okay. Well, let's talk about, I guess, if you could say like the fourth quarter of 2025 here. Starting on the livestock side, what are the major factors that are at play in the markets affecting livestock, especially leading into and here in the last quarter of 2025?
There's several major factors, obviously, across the cattle markets, but I would say some of the biggest headlines that we've dealt with and will continue to deal with is obviously the New World screwworm and the impacts that's had on the U.S. and Mexico border. That's really a never-ending headline, and it's going to continue to stay forefront to the cattle markets. Another major headline as we round out the year and work into next year is the Trump and the Trump administration's desire for lower beef prices. And they've went the route that they've went so far is lowering tariffs, mainly on Argentina, and now recently he lowered his own tariffs that he put on Brazil. And he took the tariffs on Brazil up to 50% and then just took them off of beef, coffee, sugar, and some other commodities. But the big one was beef, with everything that we're dealing with right now. Brazil, they still have a 26.4% quota tariff, And that goes into effect when they reach their quota. And in the last several years, Brazil reaches that quota by February because of what our beef prices have been. And so when Trump put his 50% tariffs on Brazil, that was also with on top of the 26.4%. So that completely halted any Brazil beef coming into the U.S. Well, he's since taken that 50% back off of them. So we're already starting to see an impact from the foreign beef, flowing back into the country.
So what is the practicality of the idea of doing that, just based on where we are at in the production system, and not only comparing cattle to cattle, but cattle to hogs, cattle to poultry, and things like that? Is it achievable what the administration wants to do?
Long term, I don't think it's achievable right now. Of how they're going about trying to get beef prices lower, it will have an impact. Short term, it will have an impact. When you put those tariffs on and you completely halted Brazil beef from coming into the U.S., it had an impact on our beef prices. Our beef was already high because of the shortage that we're dealing with and the tight numbers in the country. But once you took them completely out of the mix on the U.S. side, it had a big impact. Brazil, then they flooded China with beef, and we went to Australia. The U.S. has. But in the big picture of things, with the U.S. numbers getting tighter out into 26, the U.S., I believe, it's been my opinion that we have started expanding the herd over the last year. It's not the big herd expansion, though, that we need ultimately. When I say what we need, we don't need that, because when we have a huge herd expansion, we all know what's going to happen to the markets. But as far as the markets trying to sort themselves out, we're not at that herd expansion just yet. And then you get out into next year, and Australia's in a rebuilding phase, and Brazil's not far behind them. So beef globally is getting tighter out into next year. So what the administration is trying to do, I don't think long term it's gonna work. My opinion, what the administration needs to do is let free markets sort themselves out. And ultimately, if that means beef gets so high that we have demand issues, we all thought that was coming. We all know that's the end goal. That's what happened in 2014, and that's ultimately how markets, I feel that markets need to sort themselves out via supply and demand.
Matt, same question for you now, but let's turn this and talk about grains. So, fourth quarter, we're behind harvest now, into marketing what we've got stored. What are the keys to the grain markets that they're trying to sort through going into, and what are we experiencing here in the fourth quarter?
I think the big thing, harvest is put to bed. You should know what you have at this point, what you raised, what you've sold, what's shipped, what's in town, what's on farm, what's in a bag somewhere, what have you. And having that knowledge and kind of knowing where you're at, I think is the big thing now, and can start to make a plan to move forward here. I think as the market's trying to settle in here, we've gotten past the big harvest pressure. Basis should start to stabilize. It's kind of an odd situation this fall. Your corn movement's been very big. We're about 70% ahead of what we usually ship through the first quarter of the marketing year, which right now is about 275 million bushels. So a pretty significant amount. A lot of times when you see a big miss on a report on stocks, it's 300 million bushels plus or minus, and we're ahead by that pace shipping wise. So we'll see if that gets reflected in January. But while the pace has been big, ethanol production stayed very strong here. We also had a lot of acres. Harvest may be tailed off at the end with disease pressure and things like that. But there's still a lot of corn around in the immediate term here, and that's kind of got to get chewed through. But we've put a pretty big dent into it. So as far as corn goes, the market's trying to stabilize, found a level here. You tried to get a little pop off the report yesterday. They carry out stocks. They didn't touch yield, didn't touch world numbers. We rallied 4 or 5 cents. We kind of gave it back today. So we're trading the same dime we have for about the last 2-3 weeks here. I think overall, as support holds here and we come into the first part of the year, that kind of opens the door for a little bit of movement in corn. And then depending on the average farmer tax needs, whether you're moving grain this year, next, deferring money, and how that kind of moves through, as well as fund positions coming into the first part of the year, you can open a door for maybe a run into January, into that report or out of the report. Just probably not something that's going to be real big right now. But the fundamental demand behind it has been pretty good. And I think if we tie that with the dollar remaining cheap and movement there, I think that's going to help out on corn. Bean wise, we're kind of in the opposite boat here, where you've got shipments about 54% of normal. Every fall the bulkier soybean exports come from harvest till about the 1st of March when Brazil comes online with their production. So we got the trade deal. I guess, I just doesn't seem like it's fully official yet, but, buying's been going on. We had a bunch of sales on the Daily Wire today. We're maybe halfway to the initial commitments, and then, longer term, we need to see that go. But with the shipment pace being what it is, while it's slowly ramping up, it needs to pick up the pace, I think, to give the market some push there. We priced in the optimism with the big fall rally. You gave everybody an opportunity to move bushels at the highest prices of the year. That's passed now. We've acted a little bit better today, acting like we maybe have the short-term low here. So I think that's a good sign. It's just to get a lot more going there, you're going to need to see the shipment pace pick up. And then also into the first part of the year as the biodiesel targets start to expand with the additional crush capacity. Soil's been acting stronger here lately. If that can expand in the first part of the year, we get a little push on that front. It can go a long way, especially if yield and stocks come in a little bit tighter than expected in January. That picks up there. The other thing to watch on crush margins is meals. Giving back a bunch of its fall rally. Soy meal really rallied quite a bit this fall. We got to the point where in some hog operations, meal was getting priced out in favor of distillers' grains, and to balance the expanded use of soil, with the biodiesel and everything coming forward, we're going to need to see the domestic use of meal pick up or exports pick up there to offset, just because they need both sides of the equation to work, or both sides need to balance, and soil can't do it alone, and meal gets too cheap, it takes away from some of the ethanol margins on that end, and if it's too expensive, it loses ground in U.S. production. So you're seeing how that balances and moves along with the export pace coming into the first part of the year. It's going to be the big thing there. Probably we'll see more volatility in beans than we have in corn, and that can create some opportunities there too, especially if we see another dry spell in Brazil. They have been fairly dry coming into this past weekend. They got rains. The opposite season is effectively June there. So, while they've been a bit dry, it's being dry in spring here. You don't want to be dry, but it's not the end of the world if it rains in June. And that's, they got some rain. They caught up a little bit, but crop's also not finished. So seeing how that weather moves coming forward will play a big role, as well as how the weather finishes their growing season and moves them into the double crop corn season. That's the bulk of their exportable corn. So that'll be kind of the keys to watch there. I think, also marketing-wise, short-term with corn being kind of stuck in range, if you're looking at commercial storage prices, the lack of volatility, as opposed to where the cattle market's been, made some of the option stuff look pretty cheap. That if you're paying commercial storage, you can effectively buy calls, at the market for cheaper, that give you coverage till the end of February, cheaper than commercial storage. So that that's something to look at there. I do think we see basis get better, and that plays into the commercial factor there too. But if you're sitting on a lot in town, the flat market there, and you need to move cash bushels, there's an opportunity there to re-own and do things like that versus commercial storage on corn. Kind of the same boat with beans. There's been more volatility there, so the pricing's not quite as good on the commercial basis, but there's opportunity there for cash flow, especially while we've pulled back from the highs. We're still higher on soybeans than we were the bulk of the year. So it gives you still an opportunity to kind of do some catch-up stuff there. And if you yield it really well, you take advantage of that, and you give yourself some cash flow and ability to manage it, a little bit more flexibility into the spring on that front there. And on the wheat side of things, we've came away from the lows. There's just not a lot going on there right now. Southern Hemisphere wheat's going to be a fairly good harvest. U.S. conditions are general. For wheat, they are 48% good to excellent going into fall, which is a pretty good number for wheat, just given the area it's grown in. But that doesn't have a whole lot with how we'll come out in the spring. So it's just kind of in a holding pattern here, and I think you'll see some seasonal opportunities there, and probably some weather opportunities, especially with the lack of snow cover that's out there right now. It's just you kind of in a waiting pattern on that for right now. And I guess as a side note for any of you that grow milo, the soybeans get all the attention on the trade deal, but China, generally speaking, is a big buyer of milo. When the opportunity is there, we've seen really poor milo basis, especially into western Kansas, southwest Nebraska. We've slowly seen shipments pick up there. If milo shipments pick up, just on the smaller crop, you can see big basis swings there, and maybe something that materializes more for next fall. But that's going to be something to watch on the trade deal as well, as if that milo flow picks up, prices itself back out of rations for the Western Corn Belt feeders, as well as some of the Western ethanol producers. There's going to be some opportunities for you probably if the trade deal holds, if you're in a milo growing area.
Ross, we'll go back to you. Something big, a big announcement here in Nebraska, right? And it affects capacity to process beef. How did the trade deal with that, or is the trade still dealing with it? You know, how is this all going to balance out, do you think, in the end, Ross?
The trade has dealt with the Lexington news. The Friday we went home after the markets had closed that Friday afternoon. Lexington or Tyson came out and made that announcement about 3 o'clock after the markets closed. We opened up that Monday, limit down. We had follow through again on the following Tuesday. And I believe by Wednesday or Thursday, we were back trading above the close on Friday before the announcement came out. So for now, the markets have shaken that news off, but that news is still going to be a headwind that we continue to deal with as we move forward, because the futures market's in a good shape right now because cash has screamed here over the last, call it, week, and the likelihood is cash is going to be quite a bit stronger again this week. And that's simply due to, over the last few months, we've had plenty of big market-ready cattle in the north, and we chewed through them quicker than what a lot of us were anticipating. A lot of them cattle went south. The southern packers been buying a lot of cattle from the north, taking them down to Kansas, Texas. But the inevitable is that on January 20th, Lexington's done, Amarillo's going to a single shift. That is going to be a major headwind for the market to deal with. The market today, we're long shackle space. And we have a couple new plants that are online. You've got the plant in North Platte, and you've got another plant down in Missouri. Between those two plants, that absorbs a significant amount of Lexington going offline, but I'm not going to sit here and act like it's ever good when you lose a major packing plant. It's not. It's devastating, obviously, for the town of Lexington, but also for the cattle industry. It's a big headwind. I mean, we've seen what that does in the previous cattle cycles. When Cargill had one go off, Tyson's had them go off, back prior to 2014. But it adds to the headwind, I would say, more than anything. Right now, the thing that the cattle industry has on its side is the tighter numbers. And numbers will continue to get tighter as we head into Q1 of 26, Q2. So it's going to be a push and pull. What I tell producers, though, is don't get complacent. Don't start feeling too comfortable because there's plenty of headwinds. Obviously, Tyson's announcement's a headwind. The Trump administration, even though I said long term, I don't think it accomplishes what they're setting out to do. That's still a headwind. Anytime you have the sitting U.S. president going after commodity industry the way Trump has been, that's a headwind. That's something that the market's not used to dealing with. And obviously the other headwind is the border situation with the New World Screwworm. Because as we work through 26 and the USDA's, their plans around, getting sterile fly production facilities brought online, every day that goes by, we're one day closer to the likelihood of that border reopening.
Okay. So how is beef set up compared to the other proteins? Because, hog production, I think, came back from, they had kind of a push this summer. I think poultry has come back from the high path avian influenza. So how is beef situated compared to the other proteins?
Beef, we're going to continue to get tighter this next year. 25 production, the USDA was saying we were 4% lower year over year. And in the WASDE that came out yesterday, they're forecasting that we're going to see a 1% decline this next year into 26. But situated versus pork and poultry production is expected to go up. No surprise, as the poultry industry has recovered. Hogs, as you mentioned, the hog production had gotten tighter this last year, and that's largely been because of disease issues from earlier this year. Hog production, it looks like it's going to be steady out into 26, maybe sees a 1% increase by the time it's all said and done. But when you combine the three protein sectors, I don't see anything too burdensome, especially when we look globally at Australia and Brazil entering rebuilding phases for their beef herds as well. It's all going to coincide at the same time that the U.S. market, we're likely going to hit our tightest period.
For the time that we have left now, let's take an outlook view of some of these different sectors. And Matt, we'll start with you. How are things set up going into the big January reports? January is when we get final production numbers from the prior year. So what's the situation? What's kind of the thoughts going into that big report in January?
I think the big thing is, there's going to be a lot of looking for corn yield to be reduced. We didn't get a big reduction on the delayed November report. And a lot of times, maybe we don't get that final reduction, that everybody wants. But I think where that number kind of settles in is going to be a big thing. But the actual stocks number, I think, will probably be the bigger thing that day. You've seen where the usage is, and if the stocks number is lower, you'll probably discount whatever yield number we get there. Bean wise, I think the big thing is you could see a shock on a bigger stocks number just because of the low shipping pace. We've had great record crush the last few months. That's probably not going to completely offset it, especially during the big part of your shipping season. So, where that comes in is going to be a lot of it. You maybe see a little bit of a bean revision down just with the dry finish, and especially in the Eastern Belt. So we'll see how that sorts out, but probably not going to be a material change there. You also get a wheat acre number. The important thing there, you see, if we did get some wheat acres back late, and where that goes into the overall pie, because coming off a year where we had giant corn acres, small bean acres, and we really haven't shifted the corn-soybean ratio enough to really see a major shift there yet. How that sets up coming into the spring is going to tell us a lot. You've seen it in fertilizer prices where they're trying to get every dollar they can from you right now, but when you have 98 million acres of corn, the ball's in the nitrogen producer's court, and seeing how that sorts out. There's also tariffs and all sorts of stuff there too, but seeing how that sorts out. If beans can make a big push on the ratio and flip some acres here, I think there's going to be some incentive there that may take fertilizer prices down late, if we can get that bigger shift. And if you see the biodiesel production improve enough, we get caught up on sales there. Beans could have a lot of potential if we don't get the acres bought, and then we run into a weather situation and things moving forward. So that's going to be a lot of it. Also seeing this year, depending on where you are, if you had the southern rust, corn tailed off late. I've had more days than ever this year where the soybeans overachieved and the corn didn't, and that's kind of the opposite of what we've seen in the past, and why we always get so many corn acres is, all things being equal, corn's got more potential to the upside if you get the good weather and it grows well and it overperforms, relative to soybeans as far as just, outproducing your APH and doing things like that. So seeing how those factors come in spring and what the market bids for is going to tell us a lot. Last year it didn't bid for beans, it didn't get beans.
All right, thank you very much there, Chad, for that grain and livestock outlook. They're in 2026. We don't know what's going to happen with the markets, but I can tell you this, we'll be here at this desk to tell you every week what's been happening in the markets. We hope you'll join us all throughout 2026 as we continue to bring you Market Journal. Special thank you to you, the viewers who make this show possible. Of course, as we enter another year, hope you'll join us over the next 52 weeks for all new content for the Market Journal team. Until then, I'm Bryce Tuskett, wishing you a safe and productive week.
Join Market Journal online at marketjournal.unl.edu. You can also follow us on Twitter, Instagram, and Facebook. Promotional support is provided by the Nebraska Farmer Magazine. Market Journal is produced by the University of Nebraska-Lincoln's Institute of Agriculture and Natural Resources.